the expected return of a portfolio made up of two assets, and again with the same with the standard deviation, the risk measurement of a portfolio made up with respect to two assets. What we want to now do is try to extend that a bit further to look at what happens when we introduce more than two, and we have a combination, and how that affects the portfolio that we hold. We touched upon the importance of holding sort of optimal portfolios or efficient portfolios, but we want to extend this to see how when we have many securities, how that actually plays about when we look at the risk-return relationship. And we'll look at that today and develop, I suppose, what we call the efficient frontier, the feasible set. When we introduce risk-free assets, how that changes, and how we end up with a capital market line and then eventually a security market line, and showing how we can then use that from an investment point of view to ensure that what we're holding is efficient. Because ultimately there are so many different types of combinations of weights with respect to the different securities that we can hold. But it has to be efficient what we're holding. And we can end up showing that we ultimately will end up on a capital market line, and then ideally on this security market line when we start to look at risk a little bit more, in a little bit more detail, I suppose, in terms of how we actually measure risk and what type of risk we should be holding, what we should be considering based on the portfolio that we hold. And that will all play into when we look at portfolio performance measurements, which we will then come to look at. So if we understand this concept, then when we get to look at portfolio performance measurements, it should make a little bit more sense in itself. Okay, so, really, if you look at up to now what we've looked at, in terms of very much what we looked at last week, we looked at an investment consisting of only two securities. And then, looking at those securities, we looked at the risk and return of a portfolio made up of those two securities. We worked out the expected return, which was a simple weighted average, if you remember, of the expected return of each security, and we worked out the sort of risk, which was the standard deviation. If you remember, we used that formula, x squared of a times sigma squared of a plus x squared of b times sigma squared of b plus 2xa xb sigma a sigma b, and the correlation coefficient. And that was the formula that we used last week. We talked about, and we used it in the seminars. And then you have different weights associated with them. Is it 50-50 split? Is it 60-40, 70-30? You can have any weight combination ultimately. Now, what we want to look at is what happens when we start to increase the number of securities. So if we start with a simple example and we introduce a third security, so we could end up with our two securities A and B, but if we have a third security B, ultimately everything, all securities are going to plot somewhere in this risk-return space. Everything has to plot in the risk-return space. And our risk here is measured by our standard deviation. Our return is our expected return. So everything has to plot somewhere. So every security will plot somewhere there. We calculate the expected return and the standard deviation of that security, like we did last week, and we plot it. We position it somewhere in this risk-return space. So everything has to be there. Now let's just assume that's where they end up. Okay, we've got our three securities. We calculate the expected return and the risk, and that plots there, and C plots as such. So let's assume that's where they position themselves. Now, if we start combining these securities, so for example, if you create a portfolio made up of a combination of maybe securities C and B, then it will position somewhere between this line, depending on the correlation coefficients. If you remember the correlation coefficient, if the correlation coefficient was +1, we would have a straight line between them. But as the correlation coefficient reduces down, it starts to be curved. So let's just assume, based on the correlation coefficient, you can position yourself anywhere along there. So if you wanted to combine between B and C, you'll position somewhere there, between A and B, somewhere along there, etc., and A and C. Now, let's just assume, for argument's sake, we position ourselves at a separate investment, let's say at D. So at that point there, okay? So what we do, we basically can say, look, we've got security A and B, we're going to hold a certain proportion in each, such that we're going to be positioned at that point there. So we create a portfolio there. We then combine that with portfolio C. So we could construct a line which represents various proportion of fiction investment D and our portfolio C. So we start off, for argument's sake, combine A and B, create a portfolio, we position ourselves here, and then we can combine that portfolio D, which is a combination of A and B, with security C, and we would position ourselves somewhere along that line. So you can keep doing this basically, ultimately. So what you were doing is creating a portfolio dependent upon different weights, okay? So if you wanted to be a portfolio between D and C, you could position yourself anywhere along that curve, assuming that the correlation coefficient is such that that would be the position we would be located on. So what we're trying to show is how we can start to combine and what we end up with ultimately. Okay, now you could do this at any point. You could be positioned between A and B here, then combine it with C there. You could be here, combine it with C. It doesn't really matter, okay? So you could keep doing this, invest in different proportions in each security, made up of a combination of all three. So we can keep doing that, okay? That's the point I was trying to say. So if you were A and B, mainly A, you'll be positioned here, combine it with C, you can link there. If you were with A and C, anywhere along that line. So different combinations based on the different weights, ultimately. And what ends up, we end up with an area which is the attainable risk-return combinations. And this is called the feasible set, because it is feasible. So in other words, we can position ourselves anywhere within these three lines, based on the amount, the proportions we invest in each. Okay, based on the proportions you invest in each. So in a simple scenario, if you invested all your money 100% in C, you will be positioned at point C. If you invested 100% in B, you will be at point B. If you invested 50% in B and C, you will be positioned bang in the middle. If you then started to combine it with A, you will be positioned somewhere between that point and A. So you can keep moving about, but ultimately we have to be somewhere within here, because that's based on the combinations that we have. We won't be outside of here because there's no security up here offering us anything higher, and we won't be below that. So sorry? Oh, I thought someone asked a question. Oh, that's okay. So that's the feasible set, ultimately. Okay, so it's feasible because it is feasible to position ourselves anywhere within this space. Okay, that's our feasible set within those three lines, basically. Those are the boundaries that we end up with. Now, hopefully, when you look at this diagram, what we can see is even though we can position ourselves anywhere, some positions are going to be better than others. Okay, some positions are going to be better than others. So let's have a look at this closely. Let's take one attainable risk combination at random, anywhere within the feasible set. Let's take point Z. Okay, so point Z is a combination. Ultimately, it could be between A and B, and we position ourselves at point Z. And what we're trying to show is ultimately that some positions are better than others. And it's all to do with the risk-return relationship. Okay, so if we look at this diagram, and I'll jump a bit from one slide to the other. So we've got point Z. If we move north from point Z, we find a better combination, because such combinations have the same risk but higher expected return. So basically, if you move north from point Z, any position north is going to be better, because it offers a higher expected return for the same level of risk. Okay? So what you do, whatever position you are, you've got to move northwards. You move north up to the highest point you can, and that's point X. We can't go beyond point X because there's nothing available beyond this point based on the securities that we actually have. So point X is preferable to point Z. So basically, no investor should end up in a position where, based on the weights, they're located at that point there, even though that's within the feasible set. All because you're within the feasible set doesn't mean that that is optimal. doesn't mean that that is efficient. So you go north, you get to point X, that is any point X there is better than any other combination below. Higher return for the same level of risk. So the most advantageous point is point Z. Northwards from point Z is point X on the boundary of our feasible set. In the same way, we could move westwards from point Z and we find a better combination of projects. Because if you think about it, again, if you look back, if you move westward from point Z in a straight line, we get the same return for less risk. So basically, any position from point Z along this way, westwards, is going to be preferable to point Z. And again, you keep going until you get to your boundary of your feasible set, because there's nothing available beyond that. And we get to point Y. So any point between Z and Y is going to be preferable to Z. Okay, and ideally, the best position is Y, because it offers the lowest return for that particular level of risk. So point Y is advantageous, the most advantageous, again on the boundary of the feasible set. So what we always end up with is that we're always going to end up on the boundary of the feasible set. You don't want to be within it, you've got to end up on the boundary. So all points between X and Y in the feasible set boundary are preferable to point Z, since they've got higher return and lower risk. All the points on the boundary AC are superior to points within the feasible set. So basically, all points in the boundary AC are superior to the feasible set at the moment, because they're on the boundary and they either offer higher return for the same level of risk or lower risk for the same return. But we want to take it a little bit further as well. So let's just look at this diagram. So same diagram, but we now consider point P, which is on the boundary of our feasible set. Okay, point P. Now, we can't move any further westward, so we know that we can't reduce risk anymore and obtain the same level of expected return. But what we can do is move in a northerly direction. So when you get to that boundary, can we move upwards? So if you draw a straight line up, can we get to a better position? And the answer is here that we can. We can get to point Q on our feasible set. So basic point Q offers the same risk but higher return. And we're on the feasible set, or the boundary of it, so we know it's attainable. We can attain it, basically. So basically, all points between P and Q are going to be superior to P. So what we're trying to end up with is the most efficient position that we can attain. What's most efficient? Because that's what we always want to be holding, remember. Whatever portfolio we hold, it has to be efficient. Otherwise, we could get a better return for the same risk somewhere else. So, if you look at that previous diagram as well, while explaining this, all points along the southwest boundary are dominated by points along the northwest boundary. So you can see that hopefully all points on the southwest boundary are dominated by points on the northwest boundary. They're dominated because if you think about it, if you're positioned here, you can move up, can't you, and get a higher return for the same risk. So any point along here is dominated by that on the northwest boundary, simply by looking at risk-return relationships. So, all of the points attainable in the feasible set, only points lying along the northwest boundary are efficient in terms of the trade-off between risk and return. Whenever we talk about efficient positions, efficient portfolios, we're always talking in terms of trade-off between risk and return. So if we say an efficient portfolio, what we mean is that there is no other portfolio that offers a higher return for the same level of risk or a lower risk for the same return, okay? And that's what we mean by efficient. We often use the term mean variance efficiency. Mean is the expected return, variance is a risk measure, we show it as standard deviation, but often you will hear the term mean variance efficient. So from now on, we're really only going to be concerned with the portfolios that lie on this boundary, and this is known as the efficient frontier. So when we talk about the efficient frontier, what we're talking about is that boundary, which I'll show it in a moment in the next slide. but it means that anything that lies on the efficient frontier is mean variance efficient. Okay, so it's a case of understanding that concept. And if you look back at the last few slides, hopefully we can see that. Ultimately, like I said, you can hold any combination. You can go and select, 20 securities in the stock market and invest equal amounts in each. But are you holding a mean variance efficient portfolio? We'll see later, the more securities you hold, it won't matter as much because we diversify away. But the reality is many of us just hold a small portfolio. Most of us will maybe invest in 5, 6, 7 securities, 7 different companies, bit of money in each. And chances are that you will be positioned just somewhere in that feasible set. And that's the problem. You're not holding mean variance efficient portfolios. You should be positioned on that boundary that is known as the efficient frontier. And we show this in red, okay? Showing this here in red. If you print your slides, you'll have to just use a pen to show it off, because unless you've got a colour printer. But basically what you'll see is that this line, it basically stops at the point just before it starts to bend back on itself, okay? When you get to the point where it starts to just bend back on itself, then clearly it's not going to be efficient anymore, okay? Because ultimately we're going to be increasing the amount of return. You can start going northwards to get a higher return for the same level of risk. So the red line represents our efficient frontier. So every portfolio positioned on that efficient frontier is mean variance efficient. There is no other combination that would offer a higher return for the same level of risk, or lower risk for the same level of return. Okay, so that's our efficient portfolio, which is important within the concept of portfolio theory in itself. Now we talk about this efficient frontier, and efficient portfolios are located on this efficient frontier, but it does create a few difficulties when we try to create it. Not to the point that we can't do it, you can overcome it, but there's a few difficulties basically because of the number of securities involved in this, okay? So if you think about it, in reality there are numerous numbers of securities, okay? So you can start to do this, you can keep adding securities. You can start with 3, then you go to 5, 10, 15, 20, 50, 100, 200, 300, you keep going, depending on how many securities there are that are listed. So you can imagine for each of those securities, we need the expected return and standard deviation, then we need a combination. So you start to look at combinations, and you start to look at, when you have combinations, you have covariance, okay, that comes into play, and also you can look at the correlation coefficient as well. We talk about the correlation coefficient a lot more than the covariance, but ultimately you need to look at the combination between them. Now, if you remember last week in the seminar, I showed when we had 3, okay, when we had a portfolio made up of 3 different securities, and we showed where we needed 3 lots of covariances or 3 lots of correlation coefficients. So the number you need is given by this formula here to give you an indication of how complex it starts to get. So last week we had 3 securities. So 3 squared is 9, less 3 is 6, divided by 2 is 3. And if you remember, we showed 3 lots of correlation coefficients last week, which would have been the same as 3 lots of covariances. And you can imagine as you start to increase it, that the number will get more and more and more. So we had 3, if you had 4 squared is 16, minus 4 is 12, divided by 2, you would have 6. So think of that formula, it will get longer and longer and longer. Imagine if you had, 300, you'd be looking at 300 squared minus 300 divided by 2, huge numbers. But you would then have to do everything on a spreadsheet. So it starts to get more complex, and then you would have to then, work all this out, and you end up, somewhere hopefully on this efficient frontier. You can look at optimization to try to work out the weights as well, but it's a little bit more complex as you start to increase the number of securities. But ultimately, we will end up with an efficient frontier. So if you were to do an exercise like this and you then plotted everything, you will end up with this curve, okay? And that basically you should be positioned on that curve. If you're not positioned on the efficient frontier, we are not holding efficient portfolios. Okay, and ultimately, we're not basically getting the best return we could be getting for the unit of risk. Or there could be another portfolio which would offer less risk for the same return. So hopefully we can see by also incorporating those formulas that we used last week and we showed last week how we can get to this. Now this is all basic portfolio theory. Okay, portfolio theory is all about risk-return relationship and developing eventually your efficient frontier. It's all about looking at risky investments with portfolio theory. And with portfolio theory, like any theory, there's assumptions that underline it. And we need to we should ideally try to be aware of the assumptions and then maybe, discuss them a little bit to see how relevant they are and where there's issues associated with them. And we will talk a little bit about this also in the seminar this week. But the assumptions underlying portfolio theory are, one, investors, and all textbooks will sometimes write these a little differently, but generally speaking, this is what it's saying. Investors are rational and behave in a manner so as to maximize their utility. So what do we mean by that? Maximizing utility is all about maximizing wealth. Okay, that's really what we mean. That we all behave rationally such that we want to maximize our wealth, which is a reasonable assumption, whether, we all do that, but we should do that. It's very rare. Sometimes we have a rush of blood to the head and throw all our money in one stock, thinking it's going to do fantastically well, and we may end up losing it all. But generally speaking, we behave in a way that's rational behavior. Okay, it's rational. When we see stocks with high return, high risk, we expect high return. Okay, and we recognize that. We want to maximize our wealth. And that's reasonable to a degree. Information is free and available to all. We make decisions based on information, okay? And if markets are efficient, information should be available. But, is it free and available to everyone? There's a lot of information out there. Ultimately, what we're trying to say here is that if it's the case that some of us have information and some of us don't, then we may not be making the right decisions. And portfolio theory is all about, making decisions based upon information that's there. Based on the information, we work out expected returns, etc. But is it free and available to everyone? Sometimes we want information about companies. We can write to companies. How much of it do we get? Sometimes they may charge if there's a lot of information for their time. So those issues sometimes come into play. So we have to be aware of that. Markets are efficient, absorb all the information quickly and perfectly. Efficient markets. When we look at stock prices, is the price that's quoted accurate and correct? Well, with many developed markets, there's a lot of studies out there that will say that the markets are efficient. Yes, there are different degrees of efficiency. Those of you who've done efficiency before may be familiar with weak form, semi-strong, strong form efficiency. We will touch upon this in this module as well, efficiency. But we assume markets are efficient, and then everything is absorbed, all the information is absorbed quickly and perfectly, and the market reflects the prices accurately. So we have to assume that. Otherwise, if you don't assume that, then all the prices are wrong. If all the prices are wrong, all the returns will be wrong. Okay, so we assume the information is accurate and correct and the markets are efficient. Investors are risk averse, reasonable assumption to have. Okay, we assume that investors require compensation for taking on risk. More risk, more return, more compensation. So we always assume that investors are risk averse, and on the whole, we can pretty much say that that's the case. Maybe a few exceptions, but generally. And investors base decisions on expected return and variance or standard deviation. So we make decisions based on the risk-return element, okay, which is the basis of portfolio theory, ultimately. It's all about risk-return. Everything we do is about risk-return. So, again, we can argue, well, to a degree, that's a reasonable assumption, okay? We have to make decisions based on some parameters, some variables, and risk and return and risk, variance or standard deviation, well, that's total risk. Okay, so we can argue a little bit about the type of risk, and we will do when we look at other risk measurements. But these are basic assumptions underlying portfolio theory. Now, and one thing to recognise, I suppose, we just go back to these assumptions, just one moment. Remember, assumptions, they have to be a reasonable reflection of reality, okay? It's not saying that assumptions have to be 100% all the time, but a reasonable reflection of reality. So can we apply this generally to, when we look at the markets, when we look at investor behaviour? Like I said, there may be some crazy investors out there. We'll always get that, but generally speaking, can we apply that? And if you can, then assumptions are a reasonable reflection of reality, then we can say that they hold. But we just need to be aware of the issues surrounding them, and we can elaborate a bit more also about this in the seminar as well. So some are sort of reasonable, some are maybe a bit questionable, more the one number 2 is maybe possibly a bit more questionable. Now, portfolio theory is all about risky investments. Okay, it's all about risky investments with portfolio theory. But we can introduce another assumption here, and which starts to change everything. Because when we say risky investments, it means there's a risk associated with it, i.e. a standard deviation. But we know that in reality, you can actually have a risk-free investment as well. Okay, so we can assume that investors can invest in an investment, in a security, for example, that's got no risk. So an example of that would be a short-term government security, or even maybe a corporate bond that's got a AAA rating, something like that, which has got no risk. So the one thing though to recognise, which I suppose is more relevant now than it used to be, we always say government securities are risk-free, but you sometimes have to look closely at the rating that's associated with the government bond, okay? We always used to often say they're risk-free because they're AAA rated, but not all government bonds, if you look across countries, they've got a AAA rating. And if they haven't got a AAA rating, then sometimes, depending on how far down you go on the rating, then it's not going to be risk-free. As long as it's up there in the investment grade, so to speak, and not down in what we call the speculative grade, and definitely not down into the junk bond rating, then it's looked upon as, we can argue, risk-free. And again, we'll look a little bit at rating agencies, ratings, what they mean later on in this module. So we can assume, the assumption is we can assume that investors can invest in an investment that has no risk, i.e. a government security. And if we do that, what does that mean? In effect, it means you're lending at the risk-free rate. If you think of governments, when they want money, they issue government bonds, and then you buy government bonds, so you're lending. Same with corporations. If they issue corporate bonds, you're literally lending them money, and in return you get a coupon rate, and that's guaranteed. It's not going to vary. Say the coupon is 3%, 4%, 5%, and that's what you'll get. And again, we will look a bit at bonds also within this module in a bit more detail. So the investor is lending at the risk-free rate. And the risk-free rate has a return that's certain. It's certain because there's no risk. Okay, it's certain. And the question then comes about, well, where do we plot this in our risk-return space? And if you think about it, it's got no risk, so you think it's got to plot itself on the vertical axis, ultimately. So we end up with something like this. Our risk-free asset has to be positioned on this axis, because that's the point where you have zero risk. Exactly where it positions depends on the risk-free rate that's being offered. It's 1% or 0.5% or 1.5 or 2%, whatever it happens to be. We go in market rate for risk-free assets, it will position somewhere along that vertical axis. So that's where it positions itself in the risk-return space. So once we introduce this assumption that a risk-free asset exists, and remember this is a reasonable assumption because risk-free assets do exist, then we have to see how it changes things a little bit, because we can then start to combine that within our portfolio. So we can now combine this risk-free investment with other risky investments. Now we know that we have our efficient frontier, and that everything should position itself on the efficient frontier because that is efficient. Those are mean-beared portfolios. So we can combine with any combination, but we're only interested in on the efficient frontier. So the question is, when we think about it, what would be the return and risk of such a combination? So we know where it's positioned on the vertical axis, and we know we've got our efficient frontier made up of our efficient portfolios. So if we start to look at that, we can start to see in a minute exactly where it will be positioned and exactly what the risk will be. Okay. Now, think about it. We need to think about the expected return and think about the standard deviation. So we've got the risk-free. RF represents the risk-free investment. Now let's just assume that Y represents our portfolio. Okay, our portfolio made up of risky securities that lies on that efficient frontier. Okay, just a point on that efficient frontier, any point, as long as it's along that red line. So we know that portfolio Y is an efficient portfolio. Okay, it lies on that red line. So if we want to work out the expected return of our combination, so if we wanted to work out, say, the return of a portfolio that's made up of our efficient portfolio, but also the risk-free asset, because it does exist, the expected return will be a weighted average of the two. So it would be a weighted average of the return on the risk-free asset, RF, and the expected return on our risky portfolio, portfolio Y. Simple in terms of the same formula like we used last week, but here we've got a risk-free asset and we've got our portfolio Y, okay, our risky investment Y. It's a weighted average, okay, and the overall expected return on the portfolio would be dependent on how much we invest in each. If you invest 50% in each, our weights would be 0.5 and 0.5. Then we need our standard deviation, which we'll get from our variance of our portfolio. So it's the same formula as we used last week, but I've got different subscripts here. I've got the risk-free, and I've got our risk investment or our portfolio of risky securities Y. But it's exactly the same formula. Okay, it's a combination of two, the risk-free and our risky portfolio Y. If you think of this equation here, this equation is going to simplify right down. It's going to simplify right down. Why? Because this is the measure of risk, our variance, okay? And what would be the variance of a risk-free asset? Well, the risk of a risk-free asset is by definition zero. It's risk-free. So this term is zero. So basically, where you see this term, we're multiplying it by zero, it will disappear. X squared of the risk-free, the weight in the risk-free times the variance of the risk-free is going to be zero. You're multiplying it by zero. All this term here will disappear because we're multiplying it by zero. There's the standard deviation of the risk-free asset. The measurement of risk is zero. So all we're left with is this part here. That's all we're left with, this portion here. So the variance of our portfolio is going to equal to the weight squared in Y times the variance of Y, because everything else disappears because we're multiplying everything else by a zero. Okay, so basically we can look at if we take the square root, we've got a standard deviation which is xy sigma y. The weight, the proportion we invest in Y, 0.1, 0.2, 0.3, whatever it happens to be, times the variance of Y, the variance of our risky portfolio that's positioned on the efficient frontier, on that red line. So now what have we got? We've got our expected return and we've got our standard deviation. Both of these are simple weighted averages. They're simple weighted averages. So if you think about it, simple weighted average, all possible combinations of our risk-free investment, RF, our risk-free investment, and our risky portfolio that's positioned on the efficient frontier, that red curve, will have to plot on a straight line. Simple weighted averages, it has to plot on a straight line. So this is proving it and showing it, but we can see it in our diagram now if I do it step by step. So there's our, let's say for argument's sake, we've got three efficient portfolios, K, M, and L. Y could have been on there as well if we wanted. We could have just put Y on there and that would have been fine. So they're on our efficient frontier. So this would have been that red line, the equivalent to that red line. The risk-free asset is positioned on the vertical axis because it's got zero risk. And basically all that happens is this. If we want to combine with any of these portfolios or any along here, you just draw a straight line from the risk-free asset to your point on your efficient frontier. So here I've got 3 portfolios, K, M and L, and then we end up with 3 lines, R, F to K. So if we wanted to combine with K, we would position ourselves somewhere on that straight line. If we want to combine with R, F and L, we would position ourselves somewhere on that straight line. So if it was 50-50 split, you'd be bang in the middle, basically. If we want to combine with R, F and M, we would be somewhere on that line. So this is once we introduce a risk-free asset. And what we're trying to get to eventually is our, I suppose ultimately, is what we call a capital market line and then a security market line. Now, we can see that these are where we can position ourselves, but hopefully what we can start to see is that some positions are going to be better than others, okay? And hopefully we can start to see that. And hopefully what we can see is that, if you think about it, if you position yourself on this point, let's say halfway there, you could just go further north and get a higher return for the same level of risk. Okay, you can get a higher return for the same level of risk. So hopefully what we can start to see, is that we've got our new efficient frontier. So the line RMF, basically RFM that we've got here in red, represents portfolios are preferred to all other ones, okay, consisting of the risk-free investment and efficient portfolio. Why? Because there's no point positioning yourself there if you can go up. You can get a better return. Now we can extend this line and we'll do that in a moment. But what we're trying to show is that we end up with this new efficient frontier, okay? Do you remember before we said as long as you're positioned along that curve, it is efficient. That's fine when you've got risky investments. But as soon as you introduce a risk-free asset, once we've got a risk-free asset, the position changes slightly. Because there's no point being positioned here if you can move up and get a higher position. So basically, what we end up with is a new efficient frontier, which is a straight line. So if we want to hold, for example, a portfolio that is made up of all risky investments, and position ourselves at that point there. If we want to have a combination that's part risk-free and part risky, we'll position ourselves somewhere on this line. So if you wanted to, if as an individual you don't want much risk, you position yourself closer to the risk-free. If you want more risk, you move up closer to point M. And these are efficient in terms of, again, the risk-return relationship. Offering the higher return per unit of risk. So these are efficient. So we've got this new efficient frontier, the line RFM, which is our new efficient frontier. As long as we introduce that assumption that there exists a risk-free asset. And that assumption represents reality, because if risk-free assets do actually exist. Now, what we assume, and one of the assumptions, is that we can borrow and lend at the risk-free rate. We always assume, or an assumption is thrown in, that all investors can borrow and lend at the risk-free rate. Now let's just assume for argument's sake that that's the case, okay, and we'll question it in a moment. Assume it's the case that we can't only lend at the risk-free rate, we can borrow at the risk-free rate. And that would be the case if we had perfect capital markets. If we had perfect capital markets, we should all be able to borrow and lend at the risk-free rate. Reality is that sometimes it's a bit hard, okay? We can lend, okay, at risk-free and get a risk-free rate of return, but if you want to borrow money, borrowing at a risk-free rate is very difficult. Now, historically, the last sort of 15 years, we've had historically low levels of interest, close to zero for many, many years. But interest rates now are starting to creep up a little bit. And you've probably noticed this, that there's rumours it will go up a little bit more as well in the next announcement of the Bank of England. But this is the point where we lend and that's the point where we borrow. Borrow basically means we borrow at the risk-free rate and invest that money in the market. And then if we do that, we can move up this line, basically. Now we can extend it, up to the point, here I've shown it just here, the risk return point at Z. But this basically line is what would exist if we have perfect capital markets, okay? If we can borrow and lend at the risk-free rate. And that is not the case for everyone, okay? So we have to just recognize that. Because if we wanted to all go and borrow money, chances are that we'll be paying just slightly over and above the risk-free rate. And that would impact on the return that we would get because it's costing a little bit more. But it depends where you want to position yourself, depends on your risk preference, how much risk you are prepared to take. If you're prepared to go out and borrow huge amounts of money and invest that all in the market, then if things work out, you can move up this line. But a lot of us tend to be positioned either at this point here or somewhere between here, okay? It's it's not always the case that we will go and borrow money to invest. We can do, nothing's stopping us from doing that, but it depends how we feel about that individually. Now what we end up with, basically, is that we've got this efficient frontier, RFZ, which we can see hopefully from that diagram there, RF all the way up to Z, point Z, where investors can both borrow and lend at the risk-free rate. Now this, basically, is our capital market line, okay? When we talk about a capital market line, that is our capital market line as shown there. And I'll show the equation for that in a moment. But that's our capital market line. So our new efficient frontier, that line there, is the capital market line. Now if you look at that capital market line, what we can see, you only need two characteristics to describe it. So when we talk about the capital market line, which is capturing the relationship between the return and risk is total risk, okay, standard deviation total risk. We only need two characteristics. We need the vertical intercept. We need to know the point at which it cuts that vertical axis, and that equates to the risk-free rate. And we need to know the slope of the line, the slope of the line. And the slope of the line is in effect the price of risk, okay? The slope, it tells you how much return you're getting for every unit of risk. And the steeper it is, basically, the more return we're getting for every unit of risk. The flatter it is, the less return we're getting for every unit of risk. So the CML intercepts at the risk-free rate, the slope, the trade-off between risk and return. Now the only way, if you take an individual investor, the only way they can achieve a higher expected rate of return is to take on a greater amount of risk. Okay? Now it depends how much risk we are prepared to take on. Okay? And the slope of the line can be regarded as the price of risk. So you think of that slope, that is the price of risk that we have. And ultimately, it'd be very much dependent upon, we'll see in a moment, this market portfolio. Because if you think about it, when we started with that curve, we said any risky portfolio that's efficient will be positioned on that curve. And then we have a line that then joins from the risk-free rate to literally the tangent of that curve. That's what it's doing, that line. It's literally, imagine if you had to extend that line, if you combine the two, combine that capital market line with the old efficiency frontier, and where it's touching that line is tangential to it. And what we'll see is that that point there is our market portfolio, because that's the portfolio of risky investments. And that's the most efficient one that we can hold, because you draw the line to the risk-free rate. So ultimately, the slope of the line is regarded as the price of risk. So we end up with this capital market line, which is sort of the development on from portfolio theory. So we start with the basic portfolio theory of risk-return relationship with risky investments. We introduce the concept of a risk-free asset because it exists and because we can invest in that. So we have to combine it into our portfolio. And we end up with overall this capital market line, which tells us ultimately that that's where we need to be positioned. We need to be positioned on that line because that's sufficient. If we're not positioned on that line, i.e. somewhere below it, then ultimately we're not holding an efficient combination in terms of the portfolio that we have. So we have to recognise that point there. And let me just go through one more slide, and then we'll just take a quick 5-minute break here. So the equation for the capital market line can be stated as such. So the expected return is equal to the risk-free rate, the risk-free asset, which is the vertical, and then we've got our price of risk that we're getting. So what return are we getting for every unit of risk? And we multiply that by the amount of risk. So you could be getting 1.1% for every 1% standard deviation. If your standard deviation is 5, you'll get 5 times that, so to speak. So that's the equation there. Now, the market portfolio lies on the capital market line, because the market portfolio is a portfolio made up of all risky investments, and we know it's efficient. It's a mean variance efficient portfolio because it's made up of every single possible investment. So the market portfolio lies on the capital market line. It actually is that point M that I had in the previous graph. It's the point where it cuts it, where it's tangential, where the line is tangential to it. So if you take the market portfolio, so we know that a portfolio could be the market portfolio, so the expected return on the market will equal the risk-free rate plus the price of risk times the standard deviation of the market, because the market portfolios is one mean variance efficient portfolio. Rearrange it to show the price of risk. So if you rearrange this formula, so bring RF, if you want it to the other side, it'd be EM minus RF divided by sigma M. Just simply rearranging that formula. We end up with a price of risk equal to the excess return on the market, so that's the return you're getting to compensate for risk, okay, because risk-free is the return with no risk, divided through by the standard deviation of the market. So that is our expression for our price of risk here. Now, if you rewrite this into that equation, we end up with that expression there. So there's our price of risk up here. There's our price of risk shown here. Substitute this into that. If you substitute that into the top equation, we end up with RF plus this, which is RE, EM minus RF, divided by the standard deviation of the market, times the standard deviation of your portfolio. And that equation there is the equation for the capital market line. So when we draw the capital market line in our risk return space and we have an upward sloping line, that line is given by this equation. RF plus EM minus RF divided by the standard deviation, which basically is the price of risk, times the standard deviation of the portfolio. So for any portfolio positioned on that line, we can use this expression here to find the return on the portfolio. And clearly, if you invested all your money in a risk-free asset, then the return on your portfolio would just equal RF, okay, because we have nothing invested in the rest. But generally speaking, we will be positioned somewhere on that slope, okay, and that is the equation for that line, which is the capital market line. Okay, let's just have a 5-6 minute break, okay? I'm just gonna take a quick drink and then we'll carry this on and we'll get it up to the security market line, which will take us nicely into next week's lecture.